What's happening, guys? Today I want to talk to you about the biggest yet most neglected expense of all. And yes, that is tax. So we're going to be talking about how you can financially structure your business to potentially pay half your future tax bill. So what I have for you today is a made-up scenario. However, it uses actual real figures. We're going to be using the UK as an example, but this exact thing is applicable pretty much across the board. You just have to apply it to your own country. And before we jump in, I do have to say this is not financial advice. I'm not a financial advisor. You should always check with yours before making financial and tax decisions. So let me introduce the scenario to you, and then within the scenario I'm going to list steps that you want to take which are going to help you in structuring your business. So I want you to meet Kai and Hazel. Now, Kai and Hazel both earn £100,000 a year, okay? And you might be running a business, you might be an employee, and you're working up to earning that much. You might already be earning that much, but that's what they both earn. But Hazel pays half as much tax as Kai. How? So that's what we're going to cover here. And step number one is to choose your tax. And this is critical because the way you earn money impacts the tax applicable and therefore how much you're going to be left with. And so what you want to understand is the different taxes in your country. For example, personal income tax, corporate tax, dividend tax. Now, the least favorable one is very often personal income tax. And that's because that tax percentage taken off your income doesn't stay at a set level. Very often that percentage gets bigger and bigger and bigger as you earn more and more. Now, in my personal opinion, I think it's quite a flawed way of doing this because it actually becomes counterintuitive to earn at a certain level. That means people are literally actually cutting off income. They're not trying to earn that much because of how much they're going to be paying in tax. Sometimes earning less, they end up taking home more. And it's very situation dependent, but I've seen that multiple times. Frustrating? Yes. Unfair? No. It's just a system and you have to understand how to work that system to your advantage. Kind of like how clicking the like button helps me with YouTube system. Now, the other two taxes here, corporate and dividend, are only going to apply to those running a company. And this brings us on to step number 2. Think like a company. How you view your business, spend money, and earn money is going to impact which taxes apply and therefore how much you're left with. So let's take a closer look at Kai and Hazel and their relationships with money. So Kai earned £100,000 in the year, and he ended up actually paying £33,356 in taxes and national insurance. So that's how much was removed from his personal income, and then he took home the rest. His personal tax rate was 33.4%. So he took home £66,644. Then what he also did is he upgraded his home office for £10,000 in the same financial year, and he paid an internet bill of £1,000 for that full year. And so that ultimately left him with £55,644 of personal income that he can use for whatever. But Hazel, she did this a bit differently. And perhaps you could too. Those who are setting up businesses right now have the option to set up as a company. But even those using their skill set to the benefit of other companies right now, you too can start thinking about this and maybe even implementing this. What if you rather housed your skill set as a company and you did contractor work for specific companies? Sometimes, especially now that most people are working at home, companies will allow you to move out of an employee role into a contractor role, even when you perform the same function for them. But in these cases, like Hazel, you're running as a company. Now, one of the benefits of running as a company is that the corporate tax on that company is usually a fixed rate. That means when you earn more, that percentage does not change. It's obviously a bigger piece of money each time, but also the piece you keep is a bigger piece of money. That percentage is not growing as you grow your income. And by default, that incentivizes you to earn as much as possible with no ceiling, because you're always just paying the same percentage in taxes. So Hazel's company also earned £100,000 in the year, but this is where it gets different. Hazel, thinking as a business, decided to put through all the business related expenses. So while Kai upgraded his home office with his post-tax income, Hazel decided to write that off as a business expense. She upgraded her home office because that's where she does her work from. That allows her to complete her function and therefore produce income for the company. And so it's an allowable expense, and she reduces the company's tax bill by £10,000 while still upgrading her home office. She also wrote off her internet bill for her business for £1,000. So we take those amounts off of £100,000, and Hazel's company now has a taxable income of just £89,000. So now how does Hazel take her personal income from the company? Step number 3, this is to structure your income. Now, I think it's quite important at this point just to note that even being able to ask that question, like how do you take money from your company, you have empowered yourself at this point. That's a very good question and position to be in. And there are a few options here. So let's take the UK as an example. So currently, and these numbers can change, the UK has a personal income tax allowance of £12,500. So you can take that in almost any form and it's not going to be taxed. On the personal income tax brackets, the UK has a 20% bracket, obviously from £12,500 up to £50,000. So any money earned between those two is going to be taxed at 20%. If you earn more than £50,000 in a year, there's a higher percentage going to apply to that income. The UK also has a dividend allowance of £2,000. No tax up to £2,000 of dividends. And then the UK also has a dividend tax of 7.5%. And that's between obviously £2,001, because you get the first £2,000 free, and £50,000. Just to note, that's all income up to £50,000. So it's not like an extra, you can't take 50,000 in different forms and then 50,000 in dividends at 7.5%. It's all income. So you might have your allowances, some salary, but any of that income up to 50,000 that is made up of dividends is going to be at 7.5%. So we're about to go through Hazel's options in terms of extracting funds for personal use from her company. But before that, one thing Hazel does choose to do by default is that she takes wages or salary of £12,500 immediately. That way she's maximizing her personal allowance, and that is tax free. So she takes that out of the company, and that leaves the company with £76,500 of taxable income. So now Hazel looks over her options and she wants to maximize that £50,000 band. So there's two major routes or paths that Hazel can follow here. One is salary or wages heavy, and the other one is dividend heavy, and you can of course mix and match the two, but let's go with salary heavy to start. So here she takes £50,000 in salaries through the year. Now as before, £12,500 of that, her personal allowance, is going to be tax free. But anytime I mention this personal allowance, just remember you are going to be paying £360 of national insurance. You're not paying tax, but she is going to pay a little bit of national insurance on that. The other $37,500 of this $50,000 amount is going to be taxed at 20%. And so that's personal income tax of £7,500. Now salaries do incur NI or national insurance. So her national insurance contributions here are going to be £4,860. So that leaves Hazel with £37,640 in her pocket. At this point, we've also reduced the company's taxable income down to £39,000. And the company is going to pay a 19% corporate tax rate on that remainder. And that is going to come out to £7,410 in corporate tax. That leaves the company with an after-tax profit of £31,590. So overall here, if we look at her and her company and everything paid, her overall tax paid here is £19,770. £31,590 remains in her company as her company's after-tax profit. Hazel personally has $37,640 in personal income. That's after-tax income. And overall here, between what Hazel has and what's in her company, what she has left in her possession is £69,230. Now Hazel's effective personal tax rate just for her personal income is 24.72% here. And again, that's because she's not only paying tax here, she's also paying national insurance, and other countries have similar things like that. But Hazel's overall effective tax rate, if we take together what she paid in personal income and corporate income, overall her effective tax rate here is 19.8%. Again, that's of that initial £100,000. So let's take a look at the second option, which is dividend heavy. So here Hazel decides to take a £12,500 salary through the year, and again that is tax free. But then she decides to declare a dividend from her company. You can only declare a dividend after a company is being taxed and that company has to have a profit. That's how you declare a dividend. You can only declare if it's profitable. So at this point, the taxable income of that company is £76,500. And that's going to be taxed at the corporate tax rate of 19%, meaning the tax is going to be £14,535. That leaves an after-tax profit in the company of £61,965. She then takes dividends of $37,500 because remember, if you add the $12,500 to that, she hits the £50,000. So she takes a dividend of $37,500. That leaves $24,465 in the company. Now £2,000 of that dividend is tax-free for her personally, and that leaves $35,500 to be taxed based on the dividend rate of 7.5%. And that is going to be £2,662.50. And so from that, Hazel gains $32,837.50 in her pocket. So overall, summing this one up, the total tax paid here was £17,015. $24,465 remains in the company. Hazel has £47,337.50 in her pocket. Again, that's going to be made up of her after-tax dividend, of her dividend allowance of $2,000, and her personal allowance of $12,500. And overall here, £71,802 remains in Hazel's possession, either as her personal income or still in the company. Hazel's effective personal tax rate is just 5.3% here. And Hazel's effective tax rate overall, her personal and the company's, is going to be 17%. Again, that's of that initial £100,000. And in this case, Hazel chooses the dividend option. But it must be mentioned, these can be mixed and matched, and you can see how both can be very beneficial. So at the very end of the year, Kai has £55,644 for personal use, and he has no additional funds anywhere else, and he's paid an effective tax rate of 33.4% of his income. Hazel, on the other hand, has £47,338 for personal use. She also still has £24,465 in her company, which she can use to benefit the company or take out personally later, as we'll touch on. And she paid an overall effective rate, that's her and her company, company of 17% in taxes on her income. So even just in a personal sense, Hazel earned almost as much as Kai and paid half in taxes, but she also has that residual income still within the company. Additionally, just a side note is that Hazel also has limited liability here. If something pertaining to her work were to go wrong or have legal action taken against it, it's with Hazel's company, not Hazel herself. So she is in a way insulated from legal risk pertaining to her work, and her personal stuff is hers, while her company would be liable, but it is spreading risk in that way as well. And step 4 is to plan long term. So what are Hazel's options for the funds still remaining in her company there? Well, 1, she could reinvest that into product development, scaling her business, into R&D, or into automation, or ways to save her time with what she does. 2, she could also take out those funds in the same financial year, but it is going to be at a higher rate. She's going to pay a higher percentage on further income she pulls out because she's maxed out her 50,000 band. 3 is she could keep the funds in the company there, but she could invest them via a company investment account. So she's not needing to withdraw those funds to personally invest. She invests them as the company, and the company is going to pay the corporate tax rate on the growth, only the growth of that investment over time. That's important to note. Companies are not applied with capital gains tax generally. They are applied the corporate tax rate on investment gains. But you can see here that even if she were to do that with a really conservative return, in future years when she withdraws that at like the 7.5% dividend rate, it's going to almost nullify that 7.5% rate. So she could also grow the funds through investing them with a company investment account. And 4, she could also just save those funds in the company until a point where perhaps she stops working, and then she can withdraw them cleverly between tax years, as we've kind of gone through here. Then she can just sit, watch videos, and click the like button. I hope this video shed some light on why so many choose to run as companies, and perhaps how you can structure your next venture or even what you're busy with right now. If you enjoyed this video, please drop us a quick like, really appreciate that. Think about subscribing below and turning notifications on. That way you're not going to miss uploads like these. But I hope you guys are keeping really well, and I will see you in the next video.